Hi there, welcome to Kneppyinvests. Extremely excited to be doing this video today. Not only is this video on DGL Group the first standalone video of 2024, but DGL Group in itself looks really intriguing at the moment in terms of valuation. Now, the company itself could be argued to be interesting. They are a chemical business. But when we look at the valuation of this company, so we will look at the valuation metrics later in the video. This company looks really intriguing at current prices. Now, for those who don't know anything about DGL Group, this company listed on the ASX back about 2 years ago. So we're talking about towards the end of 2021, if I remember correctly. This company was established in 1999 by the current CEO, Simon Henry, and his vision for this company was to address a gap in the market for a fully integrated end-to-end specialty chemicals and dangerous goods business. They have three interconnected segments. So the procurement, manufacturing, formulation, and packaging of specialized chemical and materials products, the logistics and storage of dangerous and specialized goods, and hazardous waste management. Now let's have a look at the financial year 23 results for this company. Nice growth in revenue, up 26% to 466 million. Now, one little red flag when it comes to DGL Group, and there are actually quite a few red flags, some green flags as well. But one of the red flags is this company has been quite acquisitive, at least four acquisitions over the past year. And I didn't see any sort of disaggregation of their revenue in terms of organic growth versus growth through acquisitions. And I want to see how much of that revenue growth, 26%, was organic. And I didn't see any sort of commentary in regards to that. But revenue up 26%. Now, another red flag is even though revenue went up, profit down 31% to 19.2 million. So if you just compare the revenue to the profit, we can see this company does exist on low margins. So the next question I also have is, why did profit go down if revenue went up? Probably something to do with margins, but we'll talk about that in a second. Gross margins at 36.8%. Not sure if that's high or low for this type of company. I'm not that familiar with chemical companies. I would like that to be increasing through time. That's the same for all companies. I want to see gross margins or any margins increasing through time. If not increasing, at least not going down. Now, operating cash flow positive, 59.3 million. Free cash flow positive, 52.2 million. Now, if you do earn calculations with free cash flow, you might actually have a lower number than that. So you could be a little bit more conservative and have a lower free cash flow there. And the reason why I'm saying that is because when you do look at the cash flow statement, typically the difference between operating cash flow and free cash flow is capital expenditure, which is payments for property, plant, and equipment. But they also receive money for selling property, plant, and equipment. So I added that back to the free cash flow. So that's why free cash flow is a little bit higher than you might otherwise calculate. And this company is capital intensive. And we ought to see that if you do look at depreciation, amortization. Another slight red flag I have is debt. This company has net debt of 92 million. And actually that does affect a profit. In fact, it is one of the excuses the company's management used why the profit was down from last year. And I want to debate that with the management of the company, and I'll talk about that in a second as well. Now, the last thing I should mention before I move on is, why is there a discrepancy or difference between profit, 19.2 million, and operating cash flow and free cash flow between 50 and 60 million? Now, you can find the reasons why just by going through the notes. I think it's note 25, which is the reconciliation between the profit and the operating cash flow. Typically, when there is a big difference between the two, not always, but typically it's because of depreciation, amortization, and or changes in working capital. And that is definitely true for DGL Group. In fact, they had $22.4 million of depreciation and amortization, and definitely changes in working capital were quite notable for this company. So decrease in inventories of $11 million and a decrease in trade payables of $29 million. So I do think operating cash flow and free cash flow were enhanced, maybe even significantly enhanced, by changes in working capital. So if I probably calculated a fair operating cash flow and a free cash flow, I might be talking about between about 35 and 40 million. The company has 285.2 million shares on issue. The current share price is roughly 85 cents, which means the market cap of this company is 241 million. And that does seem a bit low for how this company performed in financial year 23. So there's definitely some negative sentiment in this company, and that negative sentiment has driven the company down to attractive levels in terms of valuation. So the market is highly skeptical about this company right now. Now, if you add the debt back to the market, so to get the enterprise value, which is market cap plus debt, you get $330 odd million, which is fairly similar to the equity of the company. So the current equity is 333.6 million. So we know the equity, we know the profit, and we can calculate return on equity. That's 5.8, which is definitely lower than what I would like for any company. So return equity 5.8, return invested capital 4.5. I typically want to see those two metrics at least 10, preferably above 15. Now, maybe this is just a one-off because profit did fall during the year. And if this company returns to the profit they saw in 2022, the return on equity might be approaching 10. So I would like to see at least profit of $33.6 million on equity of $333.6 million. So that is a significant red flag right now. The very low return equity and return on invested capital, and maybe a red flag for some people, but this company does not give their shareholders any dividends. They are looking for growth. They're spending all their extra cash on acquisitions, that sort of thing, for growth. And I don't have a problem with that. I actually prefer companies to do that. In fact, if a company has too high of a dividend and a dividend yield, that is a massive red flag, in my opinion. Now, why did profit fall during the year? In their commentary, they mention here financial year 23 profit decreased on the previous corresponding period, primarily due to increased finance costs from high interest rates and increased borrowings, a prior period tax adjustment, and more conservative treatment of available tax loss utilization in New Zealand. Now, this is a profit and loss statement. So I just want to see why there was a decrease in profit from last year. So it's easily determined just by looking at the profit and loss statement. So we start off with sales revenue, then cost of sales. So we can calculate the gross profit from that. So last year, the gross profit, $138 million. This year, $172 million. So if we keep going down from there, we can actually see the changes from last year to this year. And one of the biggest differences or changes is employee benefits expense, increasing from 47.4 million to 75.2 million. So that's an increase of about $28 million, which is a fairly significant increase when you look at everything else here. Administration and general expenses up about $6 million. And the other one they mentioned here was finance costs. That was up from 2.1 million to 7.6 million, which is in percentage terms a fairly big increase, but nothing like employee benefits expense. And the reason employee benefits expense increased was because of acquisitions the company made in the previous year. And in my opinion, that's the reason why profit was down from last year, was because of an increase in employees during the last financial year. The other thing I like to look at for every single company, particularly if they have different divisions or segments or whatever they want to call it, is how those individual segments are performing. Is there one segment that performs much better than the other ones? And if it does perform better and consistently performs better, would it be beneficial for the company to spin off the other two divisions and concentrate on that better performing division? And that would be one of the key decisions management have to make because, in my opinion, the two biggest decisions they have to make: capital allocation and decisions in regards to culture of the company. So these are the three divisions the company has. So chemical manufacturing, logistics, and then environmental solutions. So nice increase in revenue for all three divisions over the past few years. But if you look at the commentary below the nice little graph showing the increase, in fact, CAGR of 126% for chemical manufacturing, 59% CAGR for logistics, 32% CAGR for environmental solutions. But if you look at the last comment the last point in the commentary section in the bottom sections, you can see in chemical manufacturing, 3 acquisitions in financial year 23 contributed 13.8 million to segment revenue. So we actually can see how much organic growth this company has. So we have to figure out organic growth for ourselves. So if you take away $38.8 million from that growth in revenue, quite not as impressive, but there is still organic growth there. Logistics, 4 acquisitions in financial year 23 contributed 29.3 million to segment revenue. So if we decrease 29.3 million from 103.1 million, we get about 74 million, which is 12 million increase, organic increase from last year. And also environmental solutions, 4 acquisitions. So again, this company is highly acquisitive. 4 acquisitions contributed 28.5 million to segment revenue. So if we decrease 28.5 million from 110.4 million, we can actually see that there was no organic growth in environmental solutions. In fact, it went backwards. So probably my main point, if I was talking about the previous slide, there was a little bit of organic growth in this business, but a lot of the revenue growth in financial year 23 was because of this plethora of acquisitions the company made during the year. I'm not sure if that is a good thing moving forward, because eventually, if they keep going down this road of acquiring more companies, eventually one of the acquisitions is going to be a bad one. And that could really affect or negatively affect the company in the longer term. Now on to where it becomes really interesting for this company, valuation. Valuation matters. And even though there are some red flags and a few things I don't like about this company, in particular return on equity and return on invested capital, you can't ignore the valuation of DGL Group right now. PE ratio of 12.6. Now, sure, the profit fell from last year to this year, but if this company sees a growth or return to growth in their profit in financial year 24, the PE ratio of this company will be below 10 and maybe significantly below 10. So it's really interesting to see or find out any sort of guidance in regards to earnings for this year. So if the company comes out with a trading update and they bring out some guidance for the financial year, and they're talking about maybe a 20 or 30% increase in profit, that would mean the forward-looking PE ratio of the company is below 10. And that would be quite ridiculous for a company that has the potential to grow in the future, has a little bit of organic growth, but still has the potential to grow in the future. PB ratio 0.72. So this company is trading below book value. However, they do have a little bit of debt. So if you add that debt back, this company is trading about book value. EV to operating cash flow, one of my favorite metrics, probably just behind EV to free cash flow. Also like free cash flow yield, but EV to operating cash flow are below 6 at 5.6. Why am I saying 6? Well, my range, or the range I'm looking for in regards to EV to operating cash flow, is between 6 and 10. If I see a company between 6 and 10, and this is all company dependent as well, so this doesn't work for every single company, but if I see EV to operating cash flow, particularly for a growing company, between 6 and 10, I think there might be some value. And for DGL Group, that is below 6 at 5.6. So again, there is some argument here that DGL Group right now is pretty good value. Free cash flow yield of 21.8%. Now, this is me not being conservative when calculating free cash flow. So if you are a little bit more conservative, have a lower free cash flow, that yield will be a little bit higher, or lower, I mean. Wouldn't be higher, it would be lower. So you might be calculating a free cash flow yield of maybe 10 to 15, but still, that is quite high. So in a way, this company is trading at about 5 times free cash flow. Yes, 5 times free cash flow, which makes sense because free cash flow is not that much lower than operating cash flow. So again, just based off the free cash flow yield, that is suggesting that this company is good value. And there are has been done some research done that suggests that free cash flow yield is the best determinant on whether a company is going to outperform the market in the future. Companies with high free cash flow yields tend to outperform those companies with low free cash flow yields. That's another metric I look at. Another metric I look at is revenue growth, particularly revenue per share growth. That's another good indication on whether a company can outperform the market in the future. Also did a reverse DCF based off my non-conservative free cash flow yield. So to justify the current valuation, this company can't grow in the future. If there's any sort of growth, this company is awfully cheap. In fact, even if they decrease their free cash flow by 10% per year, it means this company is fair value. Again, if this company decreased their free cash flow at 10% per year, this company would be good or fair value right now. One thing I like to look at for all companies is just a brief financial history of the company. For DGL Group, we have about 6 years of history here. Even though they did list on the ASX back in 2021, when a company typically lists on the ASX, they do provide the last or the previous 2 years of financial statements, and that means we have 3 years of history there. So that's why we have 6 years of history when it comes to DGL Group. Really nice increase in revenue through time, increasing from 63.8 million to 466 million. And one of the reasons behind that impressive growth in revenue is because of acquisitions. And more than likely, one of the reasons this company decided to list on the ASX is to gain more access to capital because of acquisitions. They wanted to grow the company. Simon Henry wanted to grow his company through acquisitions. And to do that, he wanted access to capital. And he definitely has been provided with that. And it's been successful so far in terms of revenue growth. Now, I prefer to look at revenue per share growth, but even that has been quite impressive for DGL Group. The other two things I've included here is cash flow from operations that has been increasing every single year. And I've already mentioned, look at the free cash flow and the operating cash flow in financial year 23 with a grain of salt. You can see it increasing from $15 million in 2020 to $19 million in 2021, $27.9 million in 2022, up to $59.3 million in 2023. And the main reason behind that impressive increase in operating cash flow from last year to this year is just changes in working capital. So wouldn't be surprised to see a decrease in operating cash flow and free cash flow in financial year 24. The last thing I've included here is profit. And profit has been falling in the last 3 years from 47.2 million to 19 million. So if the company can increase some profit over the next year, so convert some of that changes in working capital to some more profitability, increase some margins, that sort of thing, I think, again, this company would become more favored in the market. Now onto the charts for DGL Group. So we have about 2 years of history, or about 2.5 years of history. Company listed on the ASX back in the middle of 2021. I'm pretty sure this company is also listed on the New Zealand Stock Exchange. So what I've done here, first time I've done this, is I do have the weekly chart, so individual weekly candlesticks. But I've also transposed on top of the candlesticks the market cap of the company through time. So the market cap should follow the chart fairly well, unless the company has done a capital raising or some sort of share buyback. And the scale for market cap is on the left-hand side, share price on the right-hand side. So when the share price did reach its peak, and when this company listed on the ASX, the company did have some tailwinds during that period from late 2021 into the start of 2022. A lot of tailwinds behind the business back then. And that's why the share price rallied quite nicely. In fact, it went from about $1.20 to a high of $4.50. And at the peak of its share price back in April of 2022, the market cap of this company was $1.2 billion. But you can see after the share price reached that high in April 2022, share price of this company has been a well-defined downtrend with a few negative announcements in there, which has not helped the sentiment behind this company. A few other things have not led to positive sentiment or the sentiment in this company changing. In particular, the actions of the CEO, Simon Henry. I think it was about a year and a half ago where he did make some probably ill-advised comments in regards to the CEO and founder of another New Zealand-based company. There was a female. It was not smart comments, but I don't look at those comments in determining whether a company is a buy, sell, or hold. I just want to know how the manager, the CEO, the founder, how he is running the company, how he is a manager. And the very fact that he's the founder of this company means that his interests in growing this company is aligned with shareholder interest as well. So anyway, the company went from having tailwinds behind it to having some headwinds. That's why the share price and the valuation has fallen over the past few years. In fact, again, the market cap of this company has fallen from 1.2 billion in April 2022 to around about, what was it, 250 million as I speak. And the share price still in the downtrend when we look at the weekly chart. Even when we look at the daily chart, so let's have a look at that right now. Even when we look at the daily chart, share price is in a long-term downtrend. And that long-term downtrend is this red ribbon thingy with that blue line in the middle. So this is the moving average ribbon. So this is a longer-term moving averages. So we're trying to talking about between 100-day, 200-day moving averages. That blue line is 150-day moving average, and that is the long-term sentiment behind this company. The shorter or the other ribbon here is the short-term sentiment, and we can actually sometimes see that sentiment of that company or any company shift in the short term. We saw that happen with DGL Group back at the start of 2023. Looked like the share price was wanting to rally around about $1.70 or so. But as soon as the share price moved into the long-term moving average, it struggled, and that share price started to fall again. The company must have released something negative in June. Share price fell like a rock in June, fell all the way from $1.20 down to a low of around about 66 cents, maybe even 65 cents. Massive volume coming in through then, around that time. But ever since then, share price has been going sideways. The greatest bit of volatility was June, July, just after they released that negative announcement. But the volatility has started to decrease. And we've also started to see decrease in volume. That's actually a good sign moving forward. So right now, with the share price consolidating, going sideways, still a long-term downtrend. But if we look at the short-term moving averages here, it's narrowing. In fact, it's almost a straight line. That is a good thing, or possibly a good thing. That means as we see less and less volatility, all those traders, short-term traders, are going out. They're leaving. They don't care about this company anymore because short-term traders love volatility. That's how they make their profits. Volatility. There was a lot of volatility back in June, so probably more than likely there would have been some day traders or short-term traders in DGL Group at this point in time. So what I'd be waiting for right now when it comes to DGL Group is a positive financial announcement. If the company can release a positive financial statement, there is potential that DGL Group's share price will break out from this consolidation phase. Who knows when that might be? It might be when they release their half-year results in February. They might release a trading update within the next few weeks. Just don't know. But at this point in time, you can remain patient. But in saying that, the valuation of this company does look really intriguing at this point in time. But even if you do like the valuation of this company right now, if you think this company is cheap, there's also the risk that the company could release a negative financial announcement. Maybe they're forecasting profit to decrease 50% in financial year 24. And if that happens, don't be surprised to see the share price fall from here. The next 5 companies I plan to do in this series includes LaserBond. Really interested to actually provide you my thoughts on a company I actually own in my portfolio, my small cap portfolio, LaserBond. So look out for that. Intrigued to do a video on Sunrise, a really interesting ticker, SGLLV, Sunrise Rise. A nice suggestion from whoever suggested that. Coventry Group, they have released some positive announcements recently. CYG, Maggie BR, MBH. So this is not analysis on the person, but the company called Maggie Beer. I'm not sure if she's has much of a role in that company, or she just put her name or let that company use her name. And then finally, the Reject Shop, a company I have been trading recently. You would think the Reject Shop should do good, should do financially well in current economic conditions with high interest rates as people look to buy cheaper stuff. But that does not equate to good financial performance from a company. And Reject Shop over the last 10 to 15 years, since I started following the company, has at times struggled when you think they should be succeeding quite well. So look out for those videos over the next, say, few weeks or so. That is all I have for this look at DGL Group's financial year 23 results. I'm really happy that I did this video right now because I really haven't looked at DGL Group for a while. And I was quite intrigued, I was going to say interested, intrigued is probably a better word, to see how this company stacks up in terms of valuation. P/E ratio of about 12, pretty low EV to operating cash flow, although operating cash flow and free cash flow have been enhanced in financial year 23 because of changes in working capital. But even so, this company could be argued is really cheap at current levels. And even when you look at the chart, share price is going sideways. And I think the market also thinks likewise that there is some value in this company. But my only concern would be if the company does release a negative financial result for the first half or a negative trading update soonish within the next few weeks, that the share price could take a tumble from here. On the flip side, if the company releases a really good financial statement in financial year 20 in February, and or a really good trading update, you might see a breakout in the share price. So if I was trading DGL Group, that would be the first thing I look for, is a breakout on a positive financial statement. Another way to play DGL Group right now is just based off valuation. If you think this company could grow significantly in the 5 to 10 years, which is definitely possible, they've been growing over the last 5 years. If you think this company can increase the margins, that sort of thing, increase the profit, you could definitely argue that this company is dirt cheap at current levels. So what are your thoughts on DGL Group? So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.